This week the focus domestically has been on jobs and also confidence, and offshore we've had the FOMC meet and provide further detail on the outlook for interest rates in the US. So starting off with the NAB business survey, what we saw there was, I guess, a somewhat of a mixed result. Conditions, so current activity in the business sector remain quite positive, recording an outcome of 10, which is well above the long-run average of 1. So that's really emphasising the positive impact that we're seeing in the economy, coming from low interest rates, lower Australian dollar, and also just the activity that both of those kind of factors are generating within the sector, and also stronger consumption. So it's a very positive outcome with regards to sort of current activity and momentum, and we're seeing that sort of pass through into jobs outcomes as well. In contrast to that, however, we saw a weaker outcome for business confidence, with that falling a couple of points to now be a little bit below its long-run average level. So it's really emphasising that despite the positive momentum we are seeing in the current sort of situation, that there's still that kind of uncertainty as to both the global outlook as well as also potentially the impact the election might have on current sort of business conditions. So until we get past those kind of key events such as Brexit overseas and also what we're seeing with regards to the federal election, we're unlikely to see sort of momentum start to improve in terms of confidence. If we switch across to consumer sentiment, what we saw there was quite a positive result. We only lost 1 point following on from an 8.5 point increase in May following the rate cut there. So that's really emphasising that we're having a more persistent impact from the RBA rate cut that was announced in May, leading to a more positive sort of family finance expectations and also a relatively favourable outlook on the economy. In terms of the 1 and 5 year outlook for the employment, for the economy, what we saw there was it did pull back, but it still only retraced part of the gain that it saw after the RBA decision. So that's really emphasising that kind of persistent impact of the RBA's rate cut there. In terms of the news recall, which we get once a quarter, that did emphasise that I guess the budget was seen as being somewhat unfavourable to household finances, and the sort of key areas of taxation were very much front and centre. That being said, family finances are benefiting at the moment from what we're seeing in terms of the labour market. So those continued job gains we have seen in recent months have meant that we are sort of seeing, I guess, less concern around the household sector with regards to their employment prospects going forward. We're now seeing the unemployment expectations index, which is part of that survey, has come down about 11% over the past year, and it's now only about 5% above its long-run average level. So that's a much more positive outcome, and one that is supportive of, I guess, more marginal consumption going forward. With regards to housing, we continue to see, I guess, a little bit of uncertainty in terms of affordability and prices, but at the same time, there is still sort of a general favouritism around sort of time to buy, and people are a little bit less risk averse at the moment, albeit a little bit more conservative than they were in 2015. If we move now to the labour force survey, what we saw there in terms of the headline outcomes was really largely as expected. 18,000 new jobs created, and unemployment rate remaining unchanged at 5.7%. But the real key sort of, I guess, detail is actually sort of looking a little bit further and assessing where these jobs are coming from. What we're seeing is that in the most recent months, and indeed over the past year, the jobs have really been all about part-time work. So over the past year, part-time jobs have risen by about 4.4%. At the same time, the sort of full-time jobs have actually only risen by 0.8%. So it's really emphasising that we are seeing a lot more of these part-time jobs created, and that's sort of, I guess, a move towards, I guess, a more flexible working environment. But it's really mainly about sort of the sectors that are actually creating jobs at the moment. So you think of tourism, education and retail, a lot of those areas do use part-time workers, and because the jobs are being created in those areas at the moment, that's the parts of the economy that are seeing the strongest growth. That's really how those jobs are transitioning through. I guess the negative in terms of sort of thinking about going forward is that potentially means there's less momentum coming through to household incomes, as people are not necessarily working as many hours as you might have hoped they would be given those sort of headline outcomes. So that's an area to watch in terms of how that plays through to sentiment and also to spending over the next kind of a quarter or so, and that will really inform how the RBA looks to go forward with regards to rates in the second half of this year. Offshore, we had one real sort of key major event, and that was the Federal Reserve meeting in the US. This was a quarterly round, so they did actually provide further forecasts with regards to how they see the economy moving forward. And the overall, I guess, statement tone was really quite important as well. As you can kind of see from market pricing, which has come back considerably after Chair Yellen spoke a week or so ago, and now after this statement, there is a growing belief that the Fed is now in a situation where it really needs to stay on hold for a while and really assess how the labour market and also inflation prospects come through in the next couple of months or so. So that's really coming off the back of the very weak outcome we saw for May for the payrolls outcome, so only about 38,000 jobs created, has really given them, I guess, quite a strong pause for thought and sort of a desire to actually assess conditions going forward, because they are really relying on the consumer coming through and providing that momentum to the US economy. So that's kind of their key focus at the moment. We continue to believe they're likely to remain on hold until September. That'll get us past Brexit and those kind of global uncertainties, and also give a little bit more time to really assess that momentum in the labour market and how that's transitioning through to the consumer sector. They did note again that sort of business investment has remained quite weak, and you're seeing the impact of the US dollar there, but they're not terribly concerned about that. They are much more focused on the consumer at the moment. Next week it's going to be a much quieter week, but the main important event will be the Brexit vote in the UK, and there I guess there's been a growing sort of a degree of uncertainty because recent polls have sort of shifted back towards a vote to yes to leave. I guess our expectation is that it is going to be quite a close vote, and it probably has some fairly significant potential implications for Europe going forward, as well as to whether this might actually lead to more sort of political discussions within the euro area itself as to whether other countries might think about, I guess, voicing their concerns around sort of where the euro is at and the potential benefits they might get from actually leaving. We'll have to wait and see what the actual vote actually transpires, but I guess the point to note is that regardless of whichever way the outcome goes, this is potentially not necessarily the end of this situation. If the UK did vote to leave, they have quite a long lead time to actually assess conditions and to actually go into negotiations with different parties around the euro area and the European Union. So it could end up being 2 or 3 years down the track before that actually comes to full resolution. Equally, if it's a close vote, but they actually vote to stay within the European Union, then equally you could still see a further vote down the track to, I guess, reassess conditions. So it's going to be sort of a point to watch going forward and how it impacts the rest of the euro area as well. So we'll come back next week and wrap that up for you.